Hello there, dividend growth stock investors. It is Colby, the DGI Crab, and I am back again with Jeremy from Dividend Stockpile. Jeremy and I had a conversation a few months back here on the channel and really thought that was a great conversation. It's always a lot of fun to talk to other dividend growth stock investors and certainly other YouTube creators as well. Jeremy, I'm really happy that you joined me here today so we can chat about dividends and YouTube and anything else that might come up. So welcome in. And if for those of you that didn't see the first round of the discussion with Jeremy, would you just introduce yourself and go ahead and plug that channel of yours?
Sounds good. Thanks, Colby. I really appreciate it. Thanks for having me on. I'm looking forward to this. As you know, I could talk about dividends all day long, so I'm more than happy to have this discussion. So for those who don't know, my name is Jeremy. I live down in Florida, have a regular 9-to-5 job, but on the side, I'm an avid dividend investor. I've been dividend investing for about 10 years or so. And a couple years back, I started a YouTube channel just to, put the message out there and get to know a little bit more about more stocks and things like that. And so, yeah, that's kind of what I do. I try to get 1 or 2 videos out a week, all about dividend investing, income investing, options trading, anything like that. So anything income related.
Super. Well, speaking of income, so Jeremy, I've noticed, especially here within the last 6 months or so, you've been doing several different interviews with fund managers, people that manage ETFs and things like that. And those have been really interesting and very illuminating on the different funds. I've definitely learned a lot about some different options that are out there that I may not have otherwise heard of. But the one I really want to delve into you with is these NEOS funds. So you've had on Troy Cates, I believe is his name, at least twice now, if I'm not mistaken, to talk about their company and their fund strategies and whatnot. And for those of you that aren't aware, NEOS, they've got about 8 or 9 different ETFs that I'm aware of right now, centered around trading options. They seem to be pretty tax efficient. A lot of you may recognize SPYI or SPYI, as I call it, their S&P 500 options fund, which has just been generating a ton of monthly yield. And I've got to say, Jeremy, when I first got wind of NEOS, I was pretty skeptical of it because there's certainly a lot of bad funds out there that trade in options and have option strategies. And I really enjoyed your discussions that you've had with Troy. They made me a believer without question. Now, something I wanted to ask you about was I was looking at the ETFs that they have available. And I did have SPYI for their S&P 500, QQQI for their NASDAQ, which I'm warming up to quite a bit as well. Now, I also noticed they had on here these alternative funds to those, SPY-H and QQQH. I'm still kind of green to them. Just overall, what are the differences between like a SPY-I and a SPY-H? How can I expect those to perform differently from one another? Is it worth owning both if you're an income seeker?
Yeah. So thanks. Yeah. So Troy over at NEOS has been very gracious with his time coming on talking about it. And to your point, I just love exploring new ETFs, seeing what's out there. I try to find the funds that are not as popular and introduce those to people. So it's been a really good experience getting to know a lot of those ETFs. But with NEOS, they do have quite a lot of ETFs. They're all based on options-based products. That's what NEOS stands for, is Next Evolution Option Strategy. So that anything that they do is going to have an options bent to it. So SPYI and QQQI are probably their most basic ones, where they buy the underlying stocks within those 2 indices, so the SPY and the QQQ. And then they write cover call options on the index. So SPY does a call on the whole SPY, and same for the Qs. And so that's how they generate all their income, is they're writing calls, they're selling calls, and they generate a premium from the buyers of those calls every single month. And that's what they distribute to us as investors. But we still do own the underlying holdings in the SPY and the QQQ. So that's just a basic one. That's going to be your highest income potential, because they're really just selling calls to get that premium, and then they pass it on to you. They do have a rules-based strategy, so it's not like the managers are sitting there picking whatever. They have a very detailed strategy that they follow month after month after month, so you don't have to worry about them going rogue and doing something crazy. They have a very structured approach to their option selling. Switching over to the H's, so QQQH and SPYH, those are what they call their hedged income products. So a lot of people want exposure to the SPY and the QQQ, but they also don't want to take full-on risk of owning those particular holdings. And so what QQQH does and SPYH is it owns the underlying holdings in each of those indices, just like we talked about before. They also write calls on those indices, but they also buy a hedge to the portfolio. They purchase some downside protection, if you will. And so that's why it's called H, is because of the hedge. So what they do is they buy the underlyings of the QQQ and SPY. They also sell calls like they did on the other part. But in addition to that, they buy a long put spread. So that's a different option strategy that they use. And basically what that does is it reduces the amount of income you get as an investor, but it does give you a certain measure of downside protection in case the market does go down. Those puts that they're buying will protect you at a certain point. And so that's really how they work. Because they are buying that options contract, it does cost them money, and that's why the distribution is lower on those. So SPYI and QQQI are going to get somewhere between the 12 and 15% yield. QQQH and SPYH are going to get around 6 to 8% annualized yield because they're buying that downside protection.
I see. So is it fair to assume then that the price volatility, especially on the downward side of it, is going to be a little bit less so with the H's than the I's? But as you pointed out, the monthly yield that you're gaining is certainly nowhere near as impressive. So maybe the H's are a little bit more for the very conservatively minded investor that still wants to get some yield, whereas the I's are maybe riskier just because they'll be a little bit more volatile, just like the underlying asset is, but they are going to generate you a lot more income.
Yeah, exactly. So it really depends on your comfort level and your income needs. So if you want to go full out exposure to the Qs and the SPY and you want to gain as much income as you can, SPY QQI is the way to go. But if you want to get some income, honestly, about half the income, but you want to have some downside protection from that put that they buy, then QQQH and SPYH might be a good alternative for you. They're not as safe as something like one of their fixed income or treasury related products. So you still do get exposure to those indices, but you get a little bit of a hedge.
Got it. So let's shift gears here a little bit. The REIT space, as real estate's just kind of struggled as a whole for the last couple of years or so, it seems, just with the higher interest rates likely being the most primary culprit in that. I have 4 REITs in my channel's list of 60 stocks. And the only other real REIT exposure that comes from anything that I'd be purchasing within my strategy would just be the roughly 25-ish% or so that the SPYD ETF holds. And that's still going to be a lot more of the same. I think all 4 of the REITs that I have on my list are at SPYD as well. Now, you have some REIT ETFs. I know that you have VNQ, which is the Vanguard REIT ETF. And I think a lot of people out there are at least somewhat familiar with it. So I don't want to spend a ton of time on VNQ. That's probably the largest REIT ETF in terms of assets under management that there is. But I know you also hold IRYI. Now, I'm not super familiar with this one. Can you tell me a little bit about IRYI? And if you were going to compare that to, say, something like just an SPYD, which obviously isn't REIT based, but again, it's about a quarter REITs. What would you say would be the advantages and the disadvantages of IRYI?
Yeah, so IYRI is another NEOS product. So you're going to have a very similar strategy to what we just talked about a few minutes ago. So just like the SPYI, QQQI, they're buying an underlying index and the underlying holdings inside of an index, which in this case is IYR, which is I think it's the iShares REIT ETF. So they're buying the 50 or 60 different REITs that are out there, and then they're writing call options on IYR as well to gain that income. So you get exposure to everything that's an IYR, all the different REITs that are out there, anyone you can think is probably in there, and then they're writing calls on it to gain that monthly income, just like all the rest of their products. So it works very similar to SPYI and QQQI. It's just on REITs instead of the S&P 500 or the QQQs. That's really the only difference. And so they generate monthly income, they pay it out to you, and then you still have exposure to the REITs. So it's a pretty good package. So that's very different than VNQ. VNQ is only going to pay you, say, 3 or 4% annualized yield, but this one is going to give you that higher income. I could pull it up, but I think it's somewhere in the 10 to 12% range on IYRI right now. So if you're looking for that current income but still want exposure to REITs, that's an option for you.
If you know off the top of your head, is the tax advantages, are they any different with IRYI versus just something like VNQ? Because VNQ is going to be normal income for being in real estate, but since this is a call option ETF, is it taxed more similarly to like SPYI, or is it still going to be considered income level dividends because it's real estate?
So to be fair, it's kind of in the middle is really what it is.
Okay.
So if you take a step back to SPYI and QQQI, when NEOS writes their options contracts, they do it on the index. So the SPY and the QQQ. When you write a call on an index, you get a favorable tax treatment. It's called Section 1256. And what it does is it allows any kind of gains you get to be 60% short-term gains and 40% long-term gains. So that's an automatic tax savings you have with those two products. In addition to that, on SPYI and QQQI, they can do tax loss harvesting on their option strategy, which I'll explain. So IYRI does not give you the index-based Section 1256 contracts because there is no REIT index. They're doing it on an ETF. You don't get that tax advantage, but you do get the tax loss harvesting. And so the way it works is when you do options in an ETF or run an ETF like NEOS does, you can offset your losses from your options contracts to your gains in your options contracts, and it cancels out for tax purposes. So let's just say they write a call for 45 days and the market changes on them and they are technically losing money on that option. Well, they can take the loss and carry it forward until they have a month that they have gains. And so if you add them all together at the end of the year, there could be some tax loss harvesting where the losses offset the gains to reduce your taxable income. So that's why I say it's kind of in the middle, because they're able to utilize the tax advantages, but they aren't able to get the Section 1256 options contracts like we talked about.
Got it. So a little bit more tax advantageous than VNQ, but not as much so as SPYI, as you said, kind of right in the middle.
Exactly. Yeah. So and VNQ, to your point, you're going to get your full, whatever your regular income tax rate is what you're going to get charged on the distributions from that. And because they don't write options in VNQ, you don't have any of the tax loss harvesting that NEOS can offer.
Very interesting. See, I think I need to pay a little bit more attention to this IRYI, because I do like the tax benefits, absolutely. And for the current income seekers, when you're buying those REITs, a big part of it is the yield. And obviously you want to buy quality REITs that aren't going to just slash their distributions all over the place. But you do want to have a pretty decent, respectable yield, especially if you're paying taxes at those ordinary income rates. And the difference between 3 to 4% on V&Q versus, well, we'll just call it a big spread. We'll say 8 to 12% on IRYI, just to cover our bases here, is pretty significant.
It is. Yeah. So I just looked up on NEOS, and their 12-month distribution right now is 11.84% on IYRI. And you get the tax advantaged income. So it's really worth a lot more than just V&Q equivalent. You're probably 3 times as good as V&Q right now.
One last thing on these NEOS funds. I'm very interested in their BTCI ETF, which is their Bitcoin ETF, which I assume just runs very, very similarly to their other products, where they're just tracking Bitcoin, not exactly an index, but they're tracking Bitcoin. Just like with the others, I see a pretty high yield on that, 10 to 15% in any given month. I believe, now you can correct me if I'm wrong, but I believe that you have some of both, right? Like, don't you have some BTCI, but then you also have, if it's not Bitcoin itself, it's one of the just Bitcoin ETFs that's
Yeah.
all it holds. It doesn't pump out a yield.
Yep, exactly. So I own BTCI from Neos. I also own IBIT from iShares, IBIT. And IBIT is just a straight up Bitcoin ETF. It's a very small percentage of my portfolio. It's in my commodities bucket is where I put it. It's like 0.5% of my portfolio or something. It's really small. But yeah, I do own direct exposure to IBIT. And then I also do have a significant position in BTCI. So we can definitely talk a little bit more about that one. So this is our highest yielding product right now.
Okay.
It's a little over 30% right now, given the volatility that Bitcoin's been having over the last couple of months.
You said 30.
30. Mm-hmm,
Wow.
30.
Okay.
Yeah. Yep.
Okay.
So, obviously that varies depending on the volatility of Bitcoin, but that's where they're averaging right now. So this one is a little bit more complex than some of their other ones, but along the same lines. So because there's no index to Bitcoin, like you said, they had to kind of structure it a little differently. So what they did is they did some tax geolocation, if you will, and have a subsidiary in the Cayman Islands.
Mm.
And that subsidiary down there can own Bitcoin ETFs directly. And so 25%, they have 25% of the fund in that subsidiary that owns Bitcoin ETFs straight out. So that's where you're going to get a lot of the upside potential of BTCI. The other 75% is what they have to play with when it comes to option strategies. And so what they end up doing for BTCI is they do synthetic cover calls on the Bitcoin ETF futures. So it's a little bit different than owning Bitcoin itself. They're actually buying on the futures contracts. Futures contracts generally have more volatility than the underlying because it's people's guess or their expectation of where Bitcoin's going to go in the future, say 30 days out, 3 months out, whatever happens to be. So they buy and sell option contracts on that Bitcoin's future, and that's where they can get that type of income. And because they're doing it synthetically, they don't actually own the Bitcoin because, again, they can't own a Bitcoin ETF except for in that subsidiary. The returns they're able to get is magnified because they're basically writing an option to get the Bitcoin, and they're writing an option to get the calls, to get the income from the Bitcoin future. Mm-hmm. And so there's like a multiplying effect, if you will. And that's why they're able to get that 30% that they're doing right now.
It's still fairly new. I think it's still hasn't quite hit even a year old just yet. But
yeah,
based on how they're structuring that, how do you think that the yield is going to be affected based on whether or not Bitcoin goes way up versus way down? So obviously, it's been known to do both over any point in time. Does the yield kind of correlate with that? Meaning, if Bitcoin is going up, the yield that's pumping out is really getting pretty large, versus if Bitcoin goes through like another crypto winter, the yield's going to drop pretty substantially. Can you tell enough based on how it's performed so far how you might estimate that what would happen based on Bitcoin volatility?
Yeah, so it's definitely going to always get a good amount of income from the volatility itself. If the market for Bitcoin keeps going up, then their cover calls are going to be worth more because buyers are going to be willing to pay more for purchasing that call option. If the market goes down, then it could affect the amount of premium they're receiving, because if buyers aren't willing to purchase a call on Bitcoin futures, then the amount of revenue or amount of income that they get could go down over time. So obviously, I don't run the fund. I don't have all these insights, and I'm not a financial advisor, so I don't know exactly what will happen. But just my common knowledge would make me believe that if there's no market for futures of Bitcoin, and then the yield is going to go down. So yeah, I would say so.
Very interesting. I'm all about having diversification within a portfolio, having exposure to different sectors. But as a dividend investor, dividend growth or higher yield, the one thing about Bitcoin, and I do own a little bit of Bitcoin, not as much as I probably would like, but it just hasn't been a big emphasis for me. Yeah. It would feel better to have that generating some income, because what I've personally found with things that are just growth related is there's so much more stress involved with them. Whereas if they go way up, maybe you're kicking yourself because maybe you trimmed your position a little bit too early, or then you buy some more and then it goes way down, and now you're stressed about that because you're down in your position. Whereas if you just hold an ETF like BTCI, volatility be damned, it's churning out income that you can use to pay the bills, and that to me just seems like that would take a little bit of the stress off of it, or at least that's how I feel about most of these assets anyway.
Yeah, I would totally agree. We've talked plenty of times. I'm an income investor first and foremost, so I wouldn't be in a big position in BTC or IBIT, but because Neo set it up that you can get income from it, it fits into my investment style. So again, I have a position. It's not a huge position. It'll never be a huge position. But to your point, diversification is a good thing. It's going to operate differently than REITs. It's going to operate differently than the SPY. So it's just one extra diversification avenue I can take. Same with their gold ETF that they just came out with through Neos. Same thing, gold itself doesn't produce an income, but because they're writing calls and owning gold, it's something that fits into my wheelhouse.
Well, I don't want it to be all about Neos, as interesting as the topic is, but you're definitely my go-to guy with that, especially because you've talked to Mr. Cates a few times and have gotten to ask a lot of direct questions on that. By the way, anyone out there, if you're watching this and you want to get some more insight on that, go over to Dividend Stockpile and check out the interviews Jeremy has done with Troy if you want to learn more about these ETFs. Now I am going to switch away from Neos now for a minute, because there was another ETF that I saw that you're buying on your channel that I hadn't heard of before, that I'd like you to give me a little bit of insight on. The ticker for it is TOPT.
Mm-hmm.
So tell me a little bit about TOPT, what's in it, and what drew you to it.
Yeah. So TOPT is a relatively new product, but it's from BlackRock, which operates the iShares ETF suite. So obviously BlackRock's been around for a very long time. They're the largest ETF provider in the world. So I feel comfortable with them running it. But what it is their top 20 US stocks ETF. So if you think back to an SPY or a VOO, you're buying the 500 largest companies here in the United States. Well, what they did is they split off just the top 20 and invest in that instead of all 500. So you get the 20 largest companies in the United States and one ETF. The reason I picked that over something like an SPY or VOO is because even though they might be in the 500 largest companies in America, doesn't necessarily mean that they're good companies. So if you invest in the S&P 500, you're getting the 499th best company and the 450th best company, and there might be struggles there. But when you focus on just the top 20, the way that the US market is set up, where it's a market cap weighted indices, you're getting all your performance, all your return based on the top holdings. And so instead of worrying about number 300 or number 400, I'm just going to pick the top 20, which have risen up over time to be the best companies in America. If they weren't the best companies, they would not be in the top 20. And so that's why I felt comfortable with that approach. And because I have so many other ETFs and so many other holdings, I didn't think I needed a full diversification of an S&P 500. I think I can get pretty good diversification just on the top 20. The main reason I went with this is because even though I own a lot of dividend growth stocks, I don't have a ton of just growth stocks. Mm-hmm. So I wanted to have a little bit of exposure to some of the names out there that don't pay dividend, or if they do pay dividend, it's like 0.5%, like Apple or Microsoft or whatever. And so this gives me a little bit of exposure to the growth side of the market, all in one package. So I don't have to go track 20 stocks or 15 stocks that I don't really want to track. So.
Sure. Well, and I've heard a lot of interesting statistics about over the last 15, 20 years, the amount of growth that the S&P 500 has experienced just as a result of like the Mag 7, mm-hmm. for example, is pretty staggering. It just seems like those top end companies, to your point, just kind of carry along, mm-hmm. numbers 300 to 500, and every year, those funds like SPY, VOO, they'll rebalance or recalibrate. You'll see some of those stocks at the bottom of the list drop off. They mm-hmm. fall out due to market cap swings, and other ones join in. So I would imagine that a top 20 would have a bit less of that, maybe
Yep.
20 and 21 will flip flop here a little bit. I don't have the market cap list right in front of me, but I
Yeah.
do like the idea, and I would imagine too you are probably still getting at least okay yield out of that, because again, I don't have the list right in front of me, but I'm sure that that probably holds. I would think maybe Exxon Mobil would be in
Hmm.
there. So you've Chevron too, perhaps. So
Yep.
probably getting some exposure to some yield plays there too. Do you know just off the top of your head what it yields?
Yeah, it's going to yield around 1%. But I mean, the top holdings, of course, you can get the Mag 7, so you can get your Microsofts and Apples, which pay about 0.5%. You also get Broadcom, which is about a 1.5%. We also have things like Berkshire Hathaway, which again, I know they don't pay a dividend, but it's not the high tech names you're thinking of. JP Morgan Chase is in the top 20. Eli Lilly, those are both good dividend payers. And so you have Visa, MasterCard, ExxonMobil, to your point, has Costco, Walmart. So Johnson & Johnson's in there. So there's plenty of non-tech names in those top 20. And so you're not just relying on the Mag 7, as you mentioned. You do have some exposure to some of the other larger companies that may not be in the tech space.
So do you not hold any S&P 500 ETF at this point? Are you all in TOPT or an SPYI?
Exactly. Yeah, I don't have an SPY. I don't have a VOO or nothing like that. To your point, I have SPYI, which gives me exposure to all 500 companies in the S&P 500. And then I have TOPT, which is a dedicated play on the top 20.
Very interesting. So I really do like that strategy, because one of the things that we do miss out on, quote unquote, as dividend investors is we're not getting the exposure to Berkshire Hathaway or to Amazon. Most of us probably aren't buying Nvidia.
Yeah.
I know they pay a dividend, but it's so negligible. I don't really know why.
Yeah, I think it's 0.3% yield or something like that.
Right, just to say that they are, and I mean, really, that's kind of been the case too with like Google and Meta. They start paying a dividend, and similar like to Apple, Microsoft is less than 1%, and I think a lot of people jumped in on those. By people, I mean dividend investors, because they were thinking, well, their payout ratios are so small that this 0.5% yield's probably going to grow 20-25% a year. And at least in the first round of increases we've seen, it looks a little bit more like Apple, where they might be doing like 5% increases. So in terms of just holding those stocks as a dividend investor, it's not particularly appealing to me, but we get exposure to them through the S&P 500. But it sounds like what you've done is you've sort of segmented out that approach and taken the S&P 500 with the NEOS fund of SPY and said, well, that's going to be something that generates me a lot of income on a monthly basis. And then my growth play is just going to be the top 20, because that's where most of that growth is coming from anyway.
That was exactly my rationale for doing it. Absolutely. Yep.
Very cool. So as far as, individual dividend stocks go, the last time that we talked, I'm sure that there was different stocks were beaten down and other ones were doing well. And now it's been a few months. There's some other ones that have recovered and some that have dropped. On the individual stock front, are there any right now that you're personally excited about that maybe you've been adding to over the past couple of weeks or so, or have you been mostly sticking toward your ETF strategy?
Yeah, so I do a little bit of both. So I definitely am primarily an ETF type of holder. I think if you were to break it down, I'm probably somewhere in the 70%, 60 to 70% ETFs between my regular dividend ETFs and my income ETFs. And I do have some individual stocks. So I actually bought two new today, so I could talk about those. So the first one was Visa.
Okay.
Obviously, high quality, everyone knows it. And it wasn't because of valuation, it's just because it is such a strong company. So I went ahead and did that. And then another one that a lot of people don't really know about, which is actually a really good quality company, is called Watts Water Technology, is WTS. And basically they do all the equipment, manufacture the plumbing, all the gadgets that go into both your residential water supply, as well as the government water supplies and things like that. So with all the focus on clean water and sustainability and things like that, they're at the forefront of water conservation, if you will. And so I see a lot of growth in that company going forward. So it's WTS Watts Water. I think they pay around a 2.5% dividend right now. And they grow it pretty regularly as well. But when you look at the quality metrics, they score almost perfect across the board. So something to consider. On on the higher end, and I'm liking.
WTS, yeah, I'm sorry, I'm just not to cut you off, I'm just kind of taking a look at what they've got here. So what I'm seeing right now is a dividend yield of 0.86%, 19% payout ratio, with a 5-year growth rate at 14.5% and 12 consecutive years of dividend growth. So
There you go.
definitely looks like a nice dividend compounding play. No question about that. And water, to your point, and anything that, operates along those lines, that's kind of a necessity, right?
Yeah.
Like, we're going to have to continue to have clean water and good plumbing and everything else. So,
Yeah. Another thing that really drove me to that one is I've been looking for a water type of play for a long time, because a lot of the infrastructure that we have out there is actually really old. A lot of the piping and stuff like that came around in the 50s, 60s, and 70s. So it's 50 plus years old right now. So all these municipalities are going to have to start replacing their water systems. And so that's only going to benefit something like Watts Water, because they sell all the things you need to replace and make your water lines more efficient. So really like that one. More of a value play right now. I like Novo Nordisk and VO as a healthcare company, but it's down significantly off its 52-week high. So it's actually a really good deal right now. Again, top quality. It hits almost all the metrics I look for. So that's definitely one I've been adding to. And I'm not necessarily a value investor, so I'll buy just top quality. But occasionally I'll look see what's a good value. Yeah.
One of the things that I think I've just messaged you about, we haven't talked about it on a video session just yet, is and this is going back to our covered call ETF strategy here, is IDVO. So for those of you out there, if that sounds a little familiar, this is the company that makes Divo, DIVO, very popular ETF that I'm sure a lot of you are familiar with out there. I'm certainly a big fan of Divo. IDVO is basically the same strategy, right? It's just they're operating with international stocks as opposed to U.S. stocks.
Yep.
And if I'm not mistaken, I think I found out about that one from you initially too.
Yeah.
Recently, I know you did a video where you were kind of looking over, international investments. You and I are both pretty big fans of VYMI, Vanguard's dividend yield, high dividend yield international ETF. The only other one right now that to me looks like it even holds a candle to VYMI is IDVO. It is a different strategy, obviously, than VYMI is. But is IDVO one that you've gone ahead and picked up any shares of, or are you still monitoring that? Because that one's still pretty new also.
Yeah. So most directly, yes, I'm adding it to pretty regularly. I'm going to make it about a 4% position in my entire portfolio. So I'm definitely a big fan of them. It's run by a guy named Kevin Simpson. And to your point, he also runs the DIVO ETF. He also has a QDVO, which is on the NASDAQ names. But the IDVO, to your point, invest in international companies. And they do it through the ADRs, so American Depository Receipts. It's a monthly distribution, and the annual yield right now is around 6%. So compared to VYMI, you're getting a 1 or 2% higher yield than you would on that with IDVO. And basically what it is Kevin Simpson and his team pick individual stocks, so it isn't actively a managed fund, and they have about 65 holdings right now. And what they do is once they get those stocks in place, they write selective covered calls on some of the products or some of the holdings to generate that a couple extra percentage in yield. So you're going to get about 3 or 4% from the dividends from the underlying international dividend stocks, and you're going to get another 1 or 2% or maybe 3% on the options writing. So as opposed to something like SPYI, where they're trying to get you 12, 14, 15% a year, the way Kevin operates is he just wants to get a little extra juice through the options. So he's going to do a very small percentage of the portfolio is underwritten. He's going to pick individual names to write the calls on, only when it makes sense. So if he feels like the stock is going to go up just on capital appreciation, he won't write a call on it. He'll let that ride. But the stocks that he thinks are either going to be flat or down a little bit, he'll do a 1 month cover call on those to generate that little bit of income. So it's a very different approach than VYMI. It is actively managed, and it's a much smaller population of holdings, but you do get that extra 1 or 2% yield than you would on VYMI. So, yep.
I'm always looking for those income plays, especially because, when you're aged 18 to, I'd say, all the way up to about 55, I think that there's a certain amount of risk that you can reasonably tolerate with the individual single stock holdings. But as I see it, the older that you get, especially if you got a bit of a late start in life and you don't have this nice pile of dividends coming in from those growth related plays, and you're actively building that up a little bit late, playing catch up, if you will, on the yield, it gets a lot harder for me to actively preach individual single stocks. I've been going here for about a year now with my channel and the strategy that I broadcast out there. And of the 10 stocks that I put aside that are high yield specifically for income seekers that need the high yield now, the only one of those 10 that's come even close to being in the buyable range for me has been Realty Income. And even that right now is recovered enough that I would think that, I just wouldn't want to purchase it right now as an income seeker to get 5.5% yield when I could be getting 12 with SPYI and have a lot more diversification and monthly dividends. So it's been really, your channel's just been really illuminating for me, particularly on those income plays, because, you're kind of going places and covering some different things that I'm just not seeing a lot of out there right now. I finally bit the bullet within the last couple of weeks and just did an SCHD breakdown. Just like, okay, fine. I'll do one, just because it almost seems obligatory at this point that you've got some kind of content on there about that.
Yeah.
And people like to see it, popular funds, people want to know what it is. People will find your stuff that way, but it's been really cool to learn about these things, because I've probably got about a half a dozen ETFs now that I'm researching that have been a direct result of knowing you and watching your content. The last question I have for you is, outside of Troy Cates, over the last few months, and I don't want to necessarily put you on the spot, but out of some of the other fund managers that you've talked to, what was, is there one that kind of stands out to you besides Troy where, you were kind of pleasantly surprised with what they were doing, or you learned about a new fund that you decided to invest in as a result of the conversation? Have you had any experience like that this year?
Yeah, for sure. So what I do when I do interview a fund manager is I make sure that I actually own the product before I interview them. And so I do that, one, just so I have some skin in the game and understand what they're talking about, but also as just to monitor it, to see how it's performing. And one that I've really enjoyed, actually there's a couple, but one that comes to mind quickly is something called SPUT. And so that is a ETF from Innovator Funds. And what it does is, we've been talking about doing cover calls all during today's discussion. But what they do is they write puts instead of calls, which are the opposite side of a call. So a call, you already own the stock and you're selling the right to someone else to buy it. What he does is he writes a put options contract, which gives him it gives the buyer of the put the right to sell him their shares. So it's kind of the opposite of calls. But what he does is he generates monthly income by selling puts on different products. So that one I really enjoyed, and it's actually done really well just in the month or two since I've interviewed him. So that one is definitely something interesting, and it's a very different approach. There's no other funds out there that are doing a put strategy instead of a call strategy. So I really enjoyed that one. I've got a lot of information from him, and I thought it was a really cool idea that they're working on. The other ones that are really quite innovative are the ones from Vista Shares. I'm sure you guys have heard a lot about those. They have QUSA, and they also have the Omaha, OMAH ETF.
Oh, I've heard about
the one
this.
that follows Berkshire Hathaway's holdings.
Mm-hmm.
They're shooting for a 15% annual yield on their products. So that's been quite interesting to watch how those have gone. So those are really cool. I have small positions in both of those as well. I love NEOS, and so to your point, I've had them on multiple times. I'm actually going to have them on the channel in a couple more weeks to talk about one of their other products coming up. So I've really enjoyed them. The last one I'll mention is this is a manager of funds, but she does not offer a mutual fund or an ETF, and that's Jenny Harrington. So she runs separately managed accounts, large money type of accounts, but she has a 100% dividend focused portfolio for her clients. So that one was really great. I just love her strategy. I love her energy. That one was really great. So
awesome. Well, I'm going to link several of those videos down in the description below for you guys, so you can have some quick access to a couple of these that Jeremy's talked to us about here today. But definitely go over to Dividend Stockpile. Give Jeremy a subscribe if you haven't already. There's plenty of cool content on there, both on the income side and for as far as all these ETFs go, and a lot of insight on individual single stocks. You taught me another one today. I've got to go and do some more research on this Watts. See if that's one that I ought to be adding to my watch list. But I tell you what, just on cursory glance, I think it probably is going to deserve a spot, at least on the watch list for now. So always learning something new when I talk to you, Jeremy. Is there anything else that we should mention here before we wrap up?
Yeah, just obligatory. We're not financial advisors. Don't follow us directly. Do your own research, do your own due diligence. Yeah. Definitely not. And Colby, of course, I love your strategy that you do on your channel. I've watched you I feel like the very beginning of your channel, and I loved your approach of the 60 individual stocks broken into 4 categories. One of the main things I focus on is the time you have until you need the money. That really determines which products you need to buy. If you still have 20, 30 years, you can go for the low yield or high growth. Once you get older, you don't have time left to let those dividends grow. You need the higher income. So I love your strategy. I love your approach, and best of luck to you and your channel for sure.
Great. Well, thank you again so much for being on with me here, Jeremy. Dividend Stockpile, once again, is the name of the channel. And to all of you DGI investors out there, I hope that you learned something here. I know that I definitely did. Leave some love down in the comment section below. And until next time, let's keep that dividend income coming in, or stockpiling, maybe I should say.
Keep stockpiling those dividends. Thanks, Colby. Appreciate your time.
Thanks, Jeremy.